Welcome to This Explainer. Today, we're looking at a story that completely, and I mean completely, caught Wall Street off guard. Picture this, a major healthcare staffing stock that a lot of folks had honestly just written off, suddenly skyrocketing over 12% in after-hours trading. I mean, no way, right? But that's exactly what happened with AMN Healthcare after their Q2 2026 earnings release. So how on earth did a company that was seemingly on the ropes pull off such a massive earnings surprise? We're going to break down the numbers, the business units, and some really revealing unscripted comments from management to figure out exactly what's going on behind the scenes. Okay, let's dive right into this. Here's our roadmap. First, the Q2 earnings surprise, then breaking down the segments, revealing analyst questions, the balance sheet, the bull versus bear case, and finally, looking ahead to Q3. Section 1, the Q2 earnings surprise. How did a struggling stock beat expectations? Going into this quarter, expectations for AMN were, well, they were incredibly muted. Thanks to all that post-pandemic volatility. But then they dropped this number, 77 cents. That was AMN's adjusted earnings per share for the quarter. Now, the analyst estimate was sitting at a really meager 19 cents. So they didn't just beat expectations, they absolutely dwarfed them. They effectively quadrupled Wall Street's profit forecasts. And this brilliantly illustrates the macro picture. Revenue came in at $673.2 million, which is a solid 7.2% beat over the $628 million expectation. We already talked about that EPS crush, but look at adjusted EBITDA. It landed at over $73 million compared to an estimated $43 million. That is a massive 69.5% beat margin. To put that into perspective, in the exact same quarter last year, they posted a net loss of $116 million. This year, net income of $21.2 million. It's a true return to profitability. Section 2. Breaking down the segments. Where exactly does AMN make its money? To really understand how they pulled this off, we've got to look under the hood. AMN isn't just one monolithic thing, but they definitely have a heavyweight division. Nurse and Allied Solutions makes up the absolute lion's share of their business, bringing in $422 million this quarter. Physician and Leadership Solutions brought in $165 million, and Technology and Workforce Solutions kicked in $87 million. So this whole turnaround story, it's heavily driven by that massive chunk, Nurse and Allied Solutions. Let's look at exactly why that segment surged. Nurse and Allied revenue was up 11% year over year. Within that, travel nurse staffing was up 10%, and the Allied division was up 8%. Interestingly, labor disruptions, so meaning hospitals needing temporary staff to cover strikes, that actually contributed a cool $25 million in revenue this quarter. But the real headline here, at least according to CEO Caroline Grace, is that travel nurse and allied staffing volumes grew at their highest rate in 4 years. This was basically sparked by a combo of strong patient demand and AMN's really focused investments in technology-driven fulfillment. But, we have to balance the narrative here. It wasn't all popping champagne. The Technology and Workforce Solutions segment actually saw revenue drop 15% year over year. Why? Well, it was primarily due to pricing compression in their language services division and a pretty steep 20% drop in vendor management systems revenue. So while the nurses are driving the growth, the tech segment is definitely facing some real friction. Section 3, Revealing Analyst Questions. Unscripted Insights from Wall Street. The unscripted earnings call Q&A is often where Wall Street forces management to address those complicated topics they might otherwise just gloss over. A great example of this is a question posed by Toby Summer at Truett Securities. He pointed out the rising demand and asked the logical follow-up. Will rising order volumes actually lead to higher bill rates for healthcare clients? Essentially, he's asking, hey, does AMN have the pricing power to charge more right now? CEO Caroline Grace's response was actually refreshingly candid. She noted that while current bill rates are stable, sustained demand could eventually push rates higher, though industry competition is keeping rates in check for now. This is a genuinely crucial takeaway. Despite seeing the highest volume growth in 4 years, the industry is just way too competitive right now for AMN to aggressively hike their prices. Then we had this great question from Baird's Mark Marcon. He really wanted to understand the macro environment, specifically asking, what are the specific drivers behind the current slowdown in permanent hospital hiring? Like, why are hospitals turning back to AMN's temporary and travel staff instead of just, hiring their own full-time nurses? Now, what's really interesting about this is the psychology of hospital administrators right now. It is fascinating. Grace explained that post-pandemic hiring has normalized, but hospitals are incredibly focused on cost optimization. They want workforce flexibility. Rather than taking on the massive fixed overhead of permanent staff during fluctuating patient demand, hospitals are choosing to rely on the contingent, flexible labor that AMN provides. It's a strategic shift that is directly favoring AMN's core business model.
Section 4. The balance sheet. Financial health and M&A potential.
A great quarter is one thing, right? But to actually sustain a turnaround, a company needs rock-solid fundamental financial health. That brings us to this incredibly healthy leverage ratio, 1.5x. To give you an idea of how fast they've cleaned up their financials, their leverage ratio was sitting at 3.3x in the prior year. Literally cutting that in half gives them tremendous breathing room. So the crucial point is how this overall financial position empowers their future. They have $362 million in cash on hand. Now, they do have $117 million in pending client deposit settlements related to those labor disruption events we mentioned earlier that they need to pay out. But even after that, they expect to retain at least $225 million in pure cash. They carry $750 million in total debt, but their revolving credit facility is completely undrawn. What does all this mean? It allows AMN to actively participate in mergers and acquisitions. In fact, they recently acquired Jati Health and an AI leadership assessment tool, which expands their technology-enabled offerings. Basically, they have the cash to buy their way into new growth areas. Section 5. Bull versus bear case. Neutral analyst sentiment and stock forecasts. Let's play devil's advocate for a minute and impartially report on the core tension of this stock. The bulls are pointing straight to the traditional nurse and allied staffing segments returning to growth, stable bill rates, rapidly decreasing leverage, and those smart acquisitions in AI tech. The bears, on the other hand, are looking right at the declining revenue in the technology and workforce unit. They're pointing out that their vendor management software really lacks growth potential, noting that $750 million in debt is still pretty significant, and warning about ongoing margin compression. Because of these totally conflicting realities, Wall Street is, well, they're very split. Looking at aggregate analyst ratings, we basically have a three-way tie between buys, holds, and a mix of strong opinions. But the overall consensus shakes out to a hold. And here is the real kicker. Despite the stock trading up around $33 or $34 after earnings, the analyst's consensus price target is sitting down at $30.17. Basically, analysts are telling us they need to see more than just one good quarter to believe this turnaround is permanent. Section 6. Looking ahead to Q3. The roadmap for the rest of 2026. Let's move to our forward-looking forecast and see how this builds. AMN is projecting Q3 revenue between $640 million and $655 million. Notice that this is a sequential moderation, so a slight step down from Q2's highs. Why? Well, mostly because Q2 had those high-margin, non-recurring labor disruption boosts. Consequently, gross margin is expected to normalize around 27 to 27.5%, and adjusted EBITDA margin is projected to cool slightly to between 6.5% and 7.0%. It's solid, steady guidance for sure, but it's not explosive. So based on research from StockStory, here are the three major catalysts that are really going to dictate AMN's performance in the coming months. Number 1, can they sustain this travel nurse growth amid fluctuating hospital budgets? Number 2, what is the actual impact of their new AI-driven recruiting tools on their ability to fill orders faster than the competition? And number 3, how will ongoing industry consolidation play out? Like, will AMN use that big war chest of cash for more strategic acquisitions? Which leaves us with this final, provocative thought. We saw a massive earnings beat. We saw stock price surge. But with hospital pricing power capped by fierce competition and real weakness in their tech divisions, is AMN's Q2 turnaround just a temporary blip, driven by a random spike in labor disruptions? Or are we witnessing the start of a truly resilient, long-term trend for the staffing giant? It's a fascinating tension in the data, and it's absolutely something every focused learner should be watching closely over the next few quarters. Thanks so much for joining me on this explainer. I'll see you next time.